This is financial accounting. Last time we discussed the basic about the accounting equation. We mentioned about assets is equals to capital plus liability, or you can also say asset minus liability is equals to capital. So, and we also did some good examples. If you did not get the notes for last lesson, kindly let me know so that I can be in a position to share. But I remember sharing it. But moving forward, I will be sharing it to your WhatsApp group because of the limited number of students who are joining this class. I hope Ken and her friends will be able to join beginning next week so that we have a good quorum. Now, financial accounting 2, we ask ourselves, what is accounting standards? In the course of practicing as an accountant, you require to know several accounting standards that will help you to comply with the guidelines and procedures that are uniform among the several practicing firms. Therefore, we can say that accounting standard is a set of standard guidelines and procedure that are used when accounting for the affairs of most government or non-government bodies. Standard exists to ensure that accounting decisions are made in a unified and reasonable way. We normally use accounting standard to make sure that each information that you are providing is the same across. That one organization should not produce data that don't comply with another organization. So the objective of setting standard is to bring about uniformity in financial reporting and to ensure consistency in the data published by enterprises, so that most enterprises and companies will have the uniform reporting of financial position. For accounting standard to be useful tool to enhance the corporate governance and responsibility, there must be some criteria to be certified. One, a standard must provide a general understandable or a generally understood and acceptable measure of a phenomena of a concern. And second, a standard should significantly reduce the amount of manipulation of the reported numbers, and it's likely to occur in the absence of the standard. Therefore, this standard has several importances, and this importance can be summarized in below. One, as said before, standards will help us in comparability, comparing how one company is presenting financial information against another. So, of paramount to the role of accounting standard is universality that it brings to financial record keeping, that companies and all organizations are able to present the information in a similar way. Government organizations must follow accounting procedures that are the same as their counterpart, and non-government organization must also do the same. So that is one major advantages or importance of accounting standard. It gives us an opportunity to compare financial statements of government organization against another government organization, non-government organization against another non-government organization. Another importance is transparency. You are saying that accounting standards are designed to enforce transparency in an organization. The principal procedures and standards that make up the generally accepted accounting principles were chosen with the purpose of ensuring that organizations lean in the direction of openness when deciding how to provide information to the observers. That means we are disclosing information that we have as an organization to the public. Therefore, we become transparent when we follow accounting standards. Relevance. Standards work to help entities provide the most relevant information in the most reasonable way possible. In this way, an organization is guided by accounting standards will generate the kind of financial information that observers are most interested in examining. That means you are able to provide the relevant information, information that is useful to the users. Audiences, ultimately the importance of accounting standard lies in the value that it brings to the financial document for the various audience that view and make critical decisions based on it. When you produce financial information or financial statements, other organizations like banks, lenders will use this information so that they can make decisions. So the audience, the users of this information require you to comply with the accounting standards. Limitation of accounting standards. Everything in this world has advantage and disadvantage, but in this case, you are talking about what are some of the shortcomings associated with accounting standards. We say that alternative solutions to certain accounting problems may each have argument to recommend them. Therefore, when we say that we have to present the information, all of us the same, and each of us are facing different scenario, there could be an argument on why should my information comply with someone else who is in a favorable environment, who has no calamity, who has no exposure. So there should be an argument, but the ultimate sense is that regardless of the circumstances that you have, the information should be uniform. There may be a trend towards rigidity and away from flexibility in applying the accounting standard. Accounting standards cannot override the statute. That means you also have other laws within the public which cannot be overridden by the accounting standards. Like a constitution is paramount to the accounting standards. Regardless of how well our accounting standards stipulate, then the constitution carries the day. Now, when you're practicing as an accountant, there are certain professional ethics you need to comply with. One is that an accountant should have, or anyone in the accounting practice should have integrity. Integrity, a professional accountant should be straightforward and honest in all professions and business relationships. Another professional ethic is objectivity. A professional accountant should not allow bias, conflict of interest, or undue influence of others to override professional business judgment. Other professional ethics to a practicing accountant is professional competence and due care. You cannot practice an accountant when you don't know what you're doing. So a professional accountant has a continuity duty to maintain professional knowledge and skills at the level required to ensure that the client and employer receive competent professional services based on the current development in practice, legislation, and techniques. You come to practice when you have already finished your course, you have already understood what to do, and you comply with the professional due care. Confidentiality. In the process, one of the areas that people receive information about others is in the accounting profession. Therefore, when you interact with information that is useful, but can be misused by other third parties, then you should maintain confidentiality. A professional accountant should respect the confidentiality of information required as a result of professional and business relationship, and should not disclose any such information to third parties without proper and specific authority unless there is a legal or professional right or duty to disclose the same. Finally, we said that an accountant should have a good professional behavior. A professional accountant should comply with the relevant laws and regulations and should avoid any action that discredit the profession. At that point, if there is anything you will need clarification, kindly let me know. Anything that you feel require clarification. If there is nothing you need clarification as well, you can text and I will appreciate. Are we okay at that point? Confirm that we are together. And any comment, I will also be willing to hear from you. Good. You're saying that we are good. Now, we move on to accounting concepts or principles. Now, in the practice of accounting, Accounting concepts and principles are a set of broad conventions that have been devised to provide basic framework for accounting reporting. That means these are generally accepted principles that should be complied to or complied with so that you are able to work and produce correct information. One is that the following is a list of major accounting concepts and principles. One is relevance. We shall look at each of these items in my explanation below. We have relevance, reliability, matching concept, timeliness, neutrality, faithful representation, prudence, completeness, single economic entry concept, and the rest as they appear in that list. Now, we're not talking about relevance. You're talking about the kind of information that you're producing. Is it useful? How is it relevant to the circumstances that is needed? So you're saying that information should be relevant to the decision-making needs of the user. Information is relevant if it helps users of the financial statements in predicting future trend of the business or in making a decision that is paramount to the business. So confirming or correcting any past prediction they have made or providing any other future circumstances that may be useful for the business. So therefore, you're talking about when you're producing this accounting information, they should be relevant within the environment they are needed. Like a company discloses an increase in earnings per share from shillings $5 to shillings $6 since the last reporting period. The information is relevant to investor as it may assist them in confirming their past prediction regarding profitability of the company, and it will also help them in forecasting future trend in the earnings of the company. When you're talking about reliability, you're talking about information is reliable if the user can depend upon it to make material accuracy and faithfully present the information that they purport to present. Like if a bank asks for financial statement, they want to make a decision whether the client has ability to pay the loan. If the financial statement are false, then it means the banks may not be able to make correct judgment on how suitable the client is able to pay the loan. Saying that a company is being sued for damage by a rival firm, settlement of which could threaten the financial stability of the company. Non-disclosure of this information will render the financial statement unreliable for its user. When the company has, we call this contingent outcomes, like there's something that will happen based on circumstances. Like there's a case going in court, then it can be either way. A firm can either win or lose the case. So if losing the case will cause damages to the firm, then this one should be disclosed in the financial statement. Otherwise, the user of the financial displacement may not find this financial statement reliable. What is it about reliability? Neutrality, we are saying that information contained in the financial statement, attempting to present them in favor light, information should be deliberate based on deliberate bias or systematic bias. In this, we are saying that information should be neutral, should not be in a sense that it only favors the company. It should also favor the users of the financial information. So, the other concept I want to talk about is faithful representation. I'm talking about this area that will be commonly tested in your exam. But since I will share this document, you'll be able to read in details. Faithful representation, you are talking about information presented in the financial statement should be faithfully presented. It should faithfully represent the transaction and events that occurred during the period. You see, we shall look at accruals and cash basis recorded. You should record items as they happen. There should be fair representation, faithful representation. That means the correct information should appear on your financial statement. Now, by prudence means that preparation of financial statements require the use of professional judgment in the adoption of accounting policy and estimate. Prudence requires that accountants should exercise a degree of caution in the adoption of policy and significant estimate that the asset and income of the entity are overstated are not overstated, where liability and expense are not understated. So in this case, for instance, when you are estimating the amount of depreciation or the rate to apply for depreciation, you should not understate or you should not overstate, so that depreciation can be utilized as an expense in your financial statements. So prudence here is saying exercising caution, being conscious of the information that you have. Completeness means that reliability of information contained in the financial statements is achieved only if complete financial information is provided relevant to the business and financial decision-making needs of the user. Completeness means that from the onset, the information flows with consistency until the end. Incomplete information reduces not only the relevance of the financial statement, it also decreases its reliability, since user will be basing their decision on information which only present, which only present a partial view of the affairs of the entity. Therefore, completeness means that this information should be in full. It should not be judged as if it is trying to skew or align itself with one direction. If it is for the company, it should not just favor the company alone. It should be a complete information that each and every person can see how the information move all along. Now, there are several of them. Principles that you can be able to read. But me, I will move very quick and look at money measurement concept in accounting. Remember, in financial statement, we are trying to record assets in form of money. We are trying to evaluate too much buildings, motor vehicles, everything in terms of money. So the money measurement concept is very key. So money measurement concept in accounting, also known as measurability concept, means that only transactions and events that are capable of being measured in monetary terms are recognized in the financial statements. Of course, financial statements are all in monetary terms. Then when you are recording transaction in financial statement, then this should be transactions that can be converted to monetary terms. Now, there are criteria that are recognized or established by IASB, International Accounting Standard Board. Therefore, you'll meet, I will give you this document, you'll be able to read and have a look at it. I will not go through everything. Like when you come to IAS 38, that is International Accounting Standard 38, it talks about intangible assets. It requires that internally generated goodwill shall not be recognized as an asset in the balance sheet. Intangible assets, of course, tangible assets are assets that you are able to hold, you are able to see, like motor vehicle, like building. Intangible assets are assets that you cannot easily, they are there, but you cannot easily recognize them or cannot easily see them. They are not physical. Example is goodwill, patent, copyrights. All those are assets, but they cannot be seen physically. Then IFRS 3, this is International Financial Reporting Standard. 3, business combination, permit purchase goodwill to be recognized as an asset in the financial. This is purchases of goodwill. Purchase goodwill to be recognized as an asset in the financial statement, since the cost of purchase goodwill is usually determinable objectively as an amount of consideration paid in excess of the value of other identifiable assets of the acquired business. When you're talking about goodwill here, we are talking about the excess amount of money you buy beyond the assets that are available. If I'm selling you my motor vehicle, this motor vehicle at the market rate is 800. Meaning you can only acquire this motor vehicle regardless, the market value is 800, but you pay me 1 million. It's 800,000, but you pay me 1 million. Means there is an extra 200,000 you have given me beyond the value of that motor vehicle. Then that becomes the goodwill. That means maybe that motor vehicle is known in the area. People know that when it is on the road, everyone would like to be carried by it, or there are specific interests that cause that motor vehicle to be sold beyond 800,000. Now, moving well, let me stop there and ask if there's a question. If there is any question, kindly let me know. If there is no question, kindly also let me know. I'm saying you are saying good. Okay. Now we go to matching principle. We go to matching principle. We see that matching, we see this matching is just the same that you are matching. Match means putting one against another. Matching principle requires that expense incurred by an organization must be charged to the income statement in the accounting period in which the revenue to which those expenses relate to. If the expenses that you incurred in the year 2024, you cannot record them in the year 2025. That is what we mean by matching principle. You are matching the expenses against the year in which they occurred. Yeah. Now, example of matching principle, we are talking about deferred taxation. What is deferred tax? These are taxes that are payable in the future. When they happen, they can be deferred tax asset or deferred tax liability. Based on, you see, in taxation, we have what we call depreciation and we have capital allowance. The difference of it is what will cause whether it's a deferred tax asset or deferred tax liability based on the treatment. That is a lesson for another day. But for today, we are seeing that deferred taxation, IAS 12 on income taxes require that accounting for taxable and deductible temporary difference arising in the calculation of income tax in a manner that results in a matching of tax expense with the accounting profit earned during a particular period. Cost of goods sold, we are saying that the cost incurred in manufacturing or procurement on inventory is charged the income statement according to the period in which the inventory was sold. Government grants, that is IAS 20, accounting for government grants and disclosure of government assistance. When you're getting government grants, this money you are receiving with specific conditions. Yeah. So in this case, you're saying that it requires recognition from grants as an income over the accounting period in which the related costs that were intended to be compensated by the grants are incurred by the entity. So basically, here we are talking about IAS 20 matching principle, that any expense that you incur should be matched against the year it was or it happened. So we're talking about accrual and cash basis. Accrual, we are recording the event or the transaction when it happened, not when it was paid. Cash basis, we are recording transaction when it is paid, not when it happened. So you're saying in accounting community, the expression matching principle and accrual basis of accounting are often used interchangeably. Accrual basis of accounting require recognition of income and expenses in the accounting period which they relate, rather than on a cash basis. If today you are supposed to pay a electricity bill 500, if you don't pay this, then next year or next month it will be in accrual. Yeah, that means you recognize. But on cash basis, if you don't pay electricity bill today, you only record electricity bill when you have already paid. That is the difference between accrual and a cash basis. Timeliness of accounting information. By timeliness principle in accounting refer to the need of accounting information to be presented to the user in time to fulfill their decision-making need. So the accounting information should be timely. That means it should be useful at a particular period. If shareholders want to make a decision whether to buy more shares or not, the information should be useful at that particular time. That is what we mean by timeliness of accounting information. That is the same thing. I will leave this one for you to read. I'm not going to pass everything. If there will be an issue, you let me know. But I want to explain this one. Specifically, let me touch on understandability and materiality. Understandability here, we mean that transactions and events must be accounted for and presented in the financial statement in a manner that is easily understandable by users who possess a reasonable level of knowledge of the business, economic activity, and accounting in the general, provided that the user is willing to study the information with reasonable diligence. You should not include very complex terms as per international accounting standard, what ESPA, all this information may be useful to you, but not understandable. In accounting standards or in accounting practices, we use information that even a layman can be able to understand what the content is all about. Now, materiality, you see, something that is material is something when ignored can cause a negative or positive impact. So you're saying that materiality therefore relates to the significance of a transaction, balances, and errors contained in the financial statement. Materiality defines the threshold or the cutoff point after which financial information becomes relevant to the decision-making need of the user. Something is material is when it is omitted or when it is inserted. For instance, if you omit cash balances, then it will going to reduce your assets. If you overstate your cash balances, it's going to show that you have more asset, which is false. So the amount which you ignore or the amount which you increase, it is material depending on the future outcomes or the decision that the users will have to make. So that is it about materiality. I will leave you to read. I will explain about the going concern. The going concern here, we are talking about how possible is a business to continue in operation beyond one particular year. So going concern is one of the fundamental assumptions in accounting on the basis of which financial statements are prepared. Financial statements are prepared assuming that the business entity will continue in operation in a foreseeable future within the need or intention of the part of the management to liquidate the entity or no significantly curtail its operation activity. Simply, when you are preparing your financial statement, the going concern here means, are you paying your expenses through your capital or are you paying your expenses through your profits? So that the going concern can be seen. Is your business able to be there in more than 1 year? So that is the essence behind the going concern concept. I've already mentioned about the accrual concept. And then realization concept is the opposite of going concern. If a business is cannot be recorded on a going concern concept, then it is recorded on a realization concept. In accounting, also known as revenue recognition principle, refer to application of accrual concept toward recognition of revenue. Under this principle, the revenue is recognized by the seller when is earned, irrespective of whether the cash from the transaction has been received or not. In a sale of good, revenue must be recognized when the seller transfers the risk and reward associated with the owners of the goods to the buyer. In this case, we are saying that this is generally deemed to occur when the goods are actually transferred to the buyer. Where goods are sold on credit terms, revenue is recognized as long as the corresponding receivables, which is subsequently settled after the receipt of the due amount from the customer. So in this case, what we're trying to say here is realization here, we only record when item has already been received. Is realized when cash is realized. Yeah. So that is the sense behind realization process. Similarly, when a business is not in going concern, we prepare the realization account to sell off the assets. I hope I'm understood up that point. Now, in accounting, we shall have something we called in our next topic. This is just the introduction, topic 1. We shall look at ledgers and cash books and among others, and we are going to see that there are An ledger is divided in two parts. There's a debit side and there's a credit side. When you record an item in the credit and you record an item on the debit, we shall see what is the difference between these as we move on. So we're saying double entry accounting system is based on the duality principle and was devised to account for all aspects of a transaction. Under the system aspect, a transaction is classified under two main types, either debit or credit. We shall look at this in our next topic. We shall look at this in details in our next topic. But we can wind up with this one. You can wind up with this. We say this. When you pay salaries to your staff, what happens? There is money getting out of your bank or money getting out of your cash, and there is wages or salary. So when you're recording this transaction, when money is getting out of the bank, you credit. Money getting out of the bank, you credit. Money getting into your salary, you debit. We shall prepare this practically in our next lesson. Now, when you're having sale of books for cash, what are you going to have? Your cash will increase, but your inventory will reduce. Yeah, you are selling book in cash, so you are getting more cash. So cash will increase. When cash increase, you debit, then sell revenue, you credit. You credit sales, you debit cash. What else? When you're having sale of book on credit, what are you doing here? You don't have cash, you're having receivables. Receivables or debtors. The debtors will be there, then you have sales. You have receivables, then you have sales. When you sell on credit, means you have not been paid. You have debtors. Receipt from creditors, when now you have sold on credit, they pay you. That means initially you debited the receivables, now you credit. Yeah. So what happens is the receivables you credit, and then you get the money either in cash or at bank. Now, what happens when you purchase book for cash? You are purchasing. That means either money is getting out from bank or from cash, but you have extra purchases. So you are going to have purchases 20,000, cash at bank 20,000. Lastly, we are saying utility expense. When you paid your bills, when you pay your bills, money is getting out, then that bill is debited. When money is getting out, you credit. When money is coming in, you debit. Utility expense, money coming in, you debit. Money getting out, you credit. So utility, all expenses will be debited because their corresponding entry is bank or cash, which is credited. By a double entry here, we mean that when there is a debit item, there automatically has to be a credit item. And when there's a credit item, there automatically has to be a debit item. That's the reason you're seeing when you debit cash, then you credit another item. When you credit cash, then you debit a corresponding item. So that will be clear in our next lesson. Excuse me. Finally, useful accounting information. I mentioned this one before. You see there is relevance, timeliness, reliability, consistency, comparability. Those are that is the end of our lesson for today, unless there is a question. Is there a question? Anything? Can you ask? I will be waiting in the chat. I even can comment whether I move very quick in my lesson. Okay, the last part on debit and credit. Okay. I want to repeat this part. There is something we said here. Debit is a portion of a transaction that accounts for increase in asset and expenses, and the decrease in liability, equity, and income. Any asset which is increasing, you debit. Any expense which is increasing, you debit. Any liability that is decreasing, you credit. I'm seeing another message. And I've not understood what you mean by pace is fine. Kindly confirm what you mean. Oh, you're saying the mic. Okay, I've understood. You're saying that I'm not moving fast. Okay. Now, credit is the portion of a transaction that accounts for increase in income, liabilities, and equity, or a decrease in asset and expense. The vice versa. You see, when an asset increase, you debit. When an expense increase, you debit. When an asset, when a liability decrease, you credit. When an equity decrease, you credit. And when an income decrease, you debit. Sorry, you debit. All these items are debited. The opposite is credit. When those items which, when they were decreasing, you debit. When they increase, you credit. Those items, when were increasing, you debit. When they decrease, you credit. And that is why we are saying this. I'm sorry if I've not drawn the ledger. We shall have a ledger in our next lesson. But what I'm trying to put across is this. In any accounting transaction, there are two entries. There's either a debit entry or there's either a credit entry. It shall come clear as we move on. A debit entry, we are recording all assets are debited. All assets are debited. All liabilities are credited. All expenses are debited. Like here, looking at this, you're saying payment of salary to staff. These are, you are paying salaries to staff. What is happening? You are paying out money. Your asset is reducing. You credit cash or bank. Then expenses is increasing. You debit expense. Instead of book for cash, you are selling book for cash. So you are getting more cash. Assets are increasing, you debit. When you're selling, you get sales. Sales, you credit. In simply each and every item in accounting, each and every item, when you debit an item, think of what else should be credited to make this transaction complete. There is no transaction in accounting which has a debit without a credit balance. That should be very clear. If you make a receipt from a customer, you're getting money from your customers. What is happening? Your debtors are reducing. So if debtors are reducing, you credit. Yeah? Then you are having money. So your cash is increasing. When your cash is increasing, it's an asset, you debit. And that is why it is summarized here. You are told when salary expense, when you pay salary, the salary will increase in expense, debit, decrease in asset, credit. When you sell an asset, when you have money, it is increase in asset, you debit. Sales, increase in income, you credit. That is the explanation that has been illustrated there. Is that clear? Next lesson, we shall have an example on this one and with clear charts on how to solve or put a transaction in order. That should not be, this is the end of first topic and it's just introduction. We shall have a lot to do in our next lessons. Good. I will share this document quickly after this so that you can have it, and we meet tomorrow